Brad Williams, Frugal Finance. Net present value, terminal value, and salvage value. When establishing cash flows for an individual project, practicality constrains us to estimate cash flows for a finite period, 3, 5, or 10 years, for instance. At the end of that finite period, you can make one of 3 assumptions. The most conservative approach is that and its assets become worthless. In that case, the final year of operations will show only the operating cash flows from that year. We can imagine that the project will end at the end of the analysis period and that the assets will be sold for salvage. Although we can try to calculate salvage value directly, a common assumption that is made in the salvage value is equal to the book value of the assets. For fixed assets, this will be the undepreciated portion of the initial capital contribution, whereas for working capital, it will be the combined aggregate value of the capital contribution added to working capital over the entire project duration. We can also imagine that the project will not end at the end of the analysis period and try to calculate the value of the project on an ongoing basis. This is the terminal value. In the Granite quick charge analysis, for instance, we imagine that the cash flow will continue forever and grow at the inflation rate each year. If that seems too optimistic, we can imagine that the cash flows will continue with no growth for a finite period, or even that they will drop by constant rate each year. The best approach to use will depend on the project being reviewed. For projects that are not expected to last for a long period, we can use either one of the first 2 approaches. A zero salvage value should be used if the project assets are likely to become obsolete by the end of the project life, e.g. computer hardware, and salvage can be set to book value if the assets are likely to retain significant value. For example, a building. For long-lived projects, the terminal value approach is most likely to generate better results, but with one caveat. The capital contribution and maintenance assumption made in the analysis should explain its long life. In particular, capital maintenance expenses will be much higher for projects with terminal values because the assets have to retain their earning power. For the Granite quick charge, the capital maintenance expenses climb over time and become larger than depreciation as we approach the terminal year. Net present value, company versus equity analysis. The weighted average cost of capital was the discount rate applied to the cash flows in the previous example, which were discounted before principal and interest payments. Calculate the net present value. We discounted cash flows to the company as a whole as opposed to just its equity investors using a discount rate that clarified the costs to various claimants within the business. There's a different option. We could have calculated net present value to equity investors by discounting the cash flow for equity investors that remain after debt payments at the cost of equity. Will the 2 approaches yield the same net present value? In general, they should, but only if the following assumptions hold. The debt is correctly priced and the market interest rate to compute the cost of capital is the right one, given the default risk of the company. If not, it is possible that equity investors can gain if investor rates are too low or lose if interest rates are set too high to bondholders. This, in turn, can result in the net present value to equity being different from the net present value to the company. We use the same assumptions about the financing mix used in both calculations. Note that the financing mix assumptions affects the discount rate, cost of capital in the firm approach, and the cash flows through the interest and principal payments in the equity approach. Seeing that the 2 approaches generate the same net present value, which one should we choose? Many practitioners prefer discounting cash flows to the firm at the cost of capital. It is easier to do because the cash flows are before debt payments, and therefore we don't have to calculate interest and principal payments explicitly. However, cash flows to equity make more sense because to most of us, residual cash flows are those that remain after principal and interest are made. Assets in place, the assets already owned by a company or projects that is already taken. Properties of the net present value. The net present value has several important properties that make it an attractive decision rule and the preferred rule, at least if corporate finance practitioners were doing the picking. Net present values are additive. The net present value of individual projects can be aggregated to arrive at a cumulative net present value for a business or decision. No other project decision rule has this property. The property itself has a number of suggestions. The value of a company can be written in terms of the present value of the cash flows of the project it has already taken on, as well as the expected net present values of prospective future projects. Value of company equals the summation present values of projects in place plus summation of net present value of future projects. The value of the assets currently in place is represented by the first term in this equation, and the value of anticipated future growth is indicated by the second term. Take note that projected future cash flows on these projects determine their present value. When a company terminates an existing project that has a negative present value based on anticipated future cash flows, the value of the company will increase by that amount. Similarly, with an investment in a new project with an expected negative net present value, the value of the company will decrease by that amount. When a company divests itself of an existing asset, the price received for that asset will impact the value of the company. If the price received exceeds the present value of anticipated cash flows on that project to the company, the value of the company will increase with the divestiture. Otherwise, it will decrease. When a company invests in a new project with a positive net present value, the value of the company will be impacted depending on if the net present value meets expectations. For example, a company like Apple is expected to take on high positive net present value projects, and this expectation is built in the value. Even if the new project taken on by Apple have positive net present value, there may be a drop in value if the net present value does not meet the high expectation of the financial market. When a company makes an acquisition and pays a price that exceeds the present value of the expected cash flows from the company being acquired, it is the equivalent of accepting a negative net present value project that will lead to decline in company value. Immediate cash flows are invested at the hurdle rate. Hurdle rate, a minimum acceptable rate of return that a company will accept for taking a given project. Implicit in all present value calculations are assumptions about the rate at which intermediate cash flows get reinvested. According to the net present value rule, cash flows that occur during a project's middle phase, that is between its start and completion, are reinvested at the hurdle rate, which is equal to the cost of equity for equity investors and the cost of capital for the company. Given that both cost of equity, capital are based on the returns that can be made on alternative projects of equivalent risk, the assumption should be reasonable. Net present value calculations allow for interest rate shifts. In all of the examples throughout these sections, we have imagined that the discount rate remains unchanged over time. This is not certain in every case, but the net present value can be worked out using time-varying discount rates. The general formulation for the net present value rule is as follows. NPV of project equals summation of cash flows divided by discount rate plus the tax rate minus initial funding, where CF is cash flow in period T, RT is one period discount rate applied to period T, and then N is the life of the project. The discount rate may change for three reasons. The level of interest rates may change over time, and the term structure may provide some insight on expected rates in the future. The risk characteristics of the project may be expected to change in a predictable way over time, resulting in changes in the discount rate. The financing mix on the project may change over time, resulting in changes in both the cost of equity and cost of capital. NPV calculations with time-varying discount rates. The present value of the cash flows can be computed using these formulas. And here is just a snapshot of this information. We've done this before. I know this is a repeat, but if you didn't take the previous course, then this is all new. For those of you who have taken the previous course, you're going, Brad, this is a repeat. Well, yeah, it is. Sorry, but this is the way it's laid out. Here's the information, and this is just the cash flow discounted at varying discount rates. So this could be year 1, year 2, year 3. This could be year 1, 2, and 3, and 4. Biases, limitation, and caveats. In spite of its advantage and its linkage to the objectives of value maximization, the net present value rule continues to have its detractors who point out several limitations. Because the net present value is expressed in absolute terms rather than relative terms, the scale of the projects is not factored into account. Thus, Project A may have a net present value of 200, whereas Project B has a net present value of 100, but Project A may require an initial capital contribution that is 10 or 100 times larger than Project B. Proponents of the net present value rule argue that it is surplus value over and above the hurdle rate, no matter what the project. The net present value rule does not control for the life of the project. Consequently, when comparing mutually exclusive projects with different timelines, Brad Williams, Frugal Finance, thanks for watching.